Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Palantir, the valuation debate, misses a critical signal. This article was written by Summit Research. Pause. Summary. Pause. Currently trading at close to 167 times NTM PE and 64 times NTM PS. Palantir Technologies Inc.'s elevated valuation multiples have reignited a great valuation debate, with investors increasingly questioning the durability of its premium. Yet, on an intrinsic basis, the growth and earnings expectations currently embedded in PLTR's valuation premium remain intact, supported by sustained execution consistency and AIP-driven unit economic expansion. Critical forward-looking growth indicators, including PLTR's accelerating RPO, alongside strengthening total contract value bookings and an improving composition of remaining deal value, also reinforce revenue visibility and backlog durability. Taken together, the signals suggest further upside surprises ahead of Palantir's Q4 earnings update and 2026 guidance, underscoring potential for a re-rate higher for PLTR stock from current levels. Palantir Technologies Inc., PLTR, has proven exceptional execution consistency through 2025, as highlighted through its consecutive quarters of earnings outperformance, alongside repeated upward guidance revisions. As discussed in my previous coverage on the stock, Palantir's results do not just reflect the benefits of emerging secular AI demand tailwinds, but also the compounding benefit of its optimized unit economics, enabled through AI Platform's AIP highly scalable go-to-market strategy. Specifically, the combination of AIP Bootcamp's low-cost, high-conversion sales and onboarding strategy, alongside the product's accelerated time to value, enabled by Palantir's ontology, has been a key driver of sustained operating leverage improvements and scaled margin expansion in recent years. Yet, the stock's subsequent appreciation of nearly 200%, from 2025's trough to peak, has triggered a great valuation debate, drawing questions on the durability of its current premium at 65x NTM sales and 167x NTM earnings. Consistent with my previous discussion, I believe Palantir's current valuation continues to accurately reflect its restored 30+% multi-year growth trajectory, reinforced by a better-than-expected earnings outlook that's set to compound further as AIP's superior unit economics continue to scale. And the durability of this fundamental profile remains intact. Specifically, Palantir's historical revenue inflection points have been preceded by acceleration in remaining performance obligations, RPO. The trend reflects sustained backlog expansion and reinforces accelerating conversion into realized sales. And that relationship persists today with complementary support from accelerating total contract value, TCV bookings, billings growth, and total deal value expansion. This effectively reinforces Palantir's growth visibility and demand durability, which remains underappreciated, especially after the stock's pullback since late December, which coincided with broader market observations of capital rotation out of tech and software in particular. Looking ahead, Palantir's upcoming Q4 earnings update will be pivotal as it kicks off expectations for the current year and beyond. Investors' focus will likely dwell less on past performance and instead shift towards whether its forward growth and earnings profile can keep up with the accelerating pace of accretion delivered thus far. And based on historical trends, another earnings surprise likely awaits, underscoring a potential valuation re-rate higher from current levels. A year of consistent outperformance. PLTR stock's 2025 upsurge is differentiated by its earnings compounding power. Specifically, Palantir's average 2025 growth estimate of about 54% is outpaced by comparable software peer Clearwater Analytics Holdings Inc.'s CWAN's 62%, with both demonstrating a similar long-term trajectory of expansion. Yet the Palantir stock currently trades at about 65x NTM sales, while CWAN's is valued at a much lower 8x NTM sales. The drastic gap is likely explained by differences in their respective earnings prospects. Clearwater Analytics earnings are expected to compound at a 5-year compound annual growth rate of 27.5% through 2030, while Palantir's is at 35% over the same period. Specifically, Palantir is expected to have achieved close to 77% of earnings growth in 2025, with further accretion at the 40% range over the next 2 years, highlighting a significant scale advantage over its comparable peers as AIP deployments ramp. The company's underlying business performance has effectively become a display of strong execution consistency. This is corroborated by Palantir's repeatedly raised full-year 2025 guidance in the past 3 earnings updates, which weren't conservative to begin with. Specifically, management had initially expected Palantir's 2025 revenue growth to accelerate towards 31% during the February earnings update. This was gradually increased to 54% by the time it delivered Q3 results in November. While this consistency has reinforced confidence in Palantir's 30% plus multi-year growth trajectory and played a critical role in driving the stock's upsurge towards its all-time high in early November, the shares have yet to fully recover from the post-Q3 earnings pullback since. This trend accordingly highlights a great valuation debate as investors remain cautious over the durability of Palantir's elevated valuation multiples, especially given broader market dynamics have turned less favorable for tech and software in particular. Specifically, tech valuations have been volatile since the S&P 500 index, SP 500, and NASDAQ 100 indexes, NDX, late October peak, with some of their gains being displaced by names across industrials and big pharma since. Despite signs of broader market recovery in late December and through the first few weeks of 2026, the tech-heavy NASDAQ 100's losses remain at more than 4% since its October 29 peak, versus the S&P 500's negative 1.36%, representing a cautionary tale for tech valuations ahead. This accordingly suggests heightened investor scrutiny heading into Palantir's upcoming Q4 earnings update. Specifically, focus is likely to zero in on whether Palantir can maintain its pace of revenue acceleration and earnings accretion in the year ahead to justify estimates currently embedded into its premium. And there are several indicators that continue to point to durability on that front. 1. RPO growth signals continued acceleration. Remaining performance obligations, RPO, currently represent one of Palantir's strongest and most reliable gauges of future revenue momentum. Different from remaining deal value, RDV, which presumes the exercise of all contract options and no termination of contracts across both of its core government and commercial customers. RPO doesn't account for contracts with an initial term of less than 12 months and contractual obligations that fall beyond termination for convenience clauses. Specifically, management repeatedly reminded investors that RPO consists primarily of commercial contracts, as government awards are typically subject to termination clauses and wide-ranging fulfillment timelines. As a result, RPO trends have historically been a reliable barometer of revenue visibility for Palantir, as they represent confirmed contractual obligations with high conversion certainty. Meanwhile, changes in deal value function as more of a directional indicator of forward growth prospects, given that the conversion of the full amount to revenue isn't always guaranteed. Historically, Palantir's revenue inflections have been preceded by accelerating RPO, as sustained backlog expansion underscores rapid conversion into realized sales in subsequent periods. In the past 12 months, there have been constructive patterns observed between total and current RPO expansion and their subsequent period of commercial revenue growth, in particular. As depicted by red arrows in the image above, growth observed in quarterly current RPO through 2024 has demonstrated close correlation with commercial revenue growth in the immediately subsequent period. Their differentials averaged less than 1.5 percentage points. With the assistance of generative AI, Grok, and ChatGPT, the data translated to a strong positive correlation of 0.828. This is consistent with earlier discussions that RPO is primarily reflective of commercial customer contracts, given their longer duration and lower rate of subjection to termination clauses. Yet, in the early half of 2025, there's been a shift in the pattern, where total RPO growth has displayed greater correlation with subsequent period commercial revenue growth, depicted by blue arrows. Specifically, differentials between Q1 to Q2 RPO growth and Q2 to Q3 commercial revenue growth averaged about 2.4 percentage points, with a strong statistical positive correlation. This shift, though potentially at early stages given limited data, could potentially indicate favorable changes in Palantir's RPO composition and deal dynamics, reinforcing its revenue visibility ahead. Contract duration has likely increased. Historically, Palantir's RPO has been skewed to current contracts realizable into revenue within 12 months. This is consistent with the fact that it was still in the early stages of its land and expand growth model for its product portfolio, including AIP, introduced in 2023. The dynamic suggests Palantir's exposure to a larger mix of smaller and shorter duration contracts, which typically signals faster conversion to revenue. This would also be consistent with the strong correlation observed between current RPO and forward commercial revenue growth observed through 2024, as discussed earlier. Based on the Q3 2025 10Q, more than 56% of Palantir's RPO is now non-current. In other words, Palantir's largely guaranteed backlog is now predominantly stemming from long-term contracts that aren't expected to be fulfilled and recognized into revenue until more than a year later. This compares to a small non-current mix at 54% in Q3 2024 and 47% in Q1 2024 when RPO started growing again following the extended macro headwinds experienced through 2023. The company also continued to acquire bigger contracts in Q3, with 83 new deals worth $1 million or more, out of which 40 had contract values exceeding $5 million, and 21 of them exceeded $10 million. With deal size and contract duration on the rise, revenue recognized in the immediately following quarter is increasingly driven by Palantir's aggregate backlog, i.e., total RPO, rather than just what's concentrated within the current bucket. This would be consistent with the increasing correlation between Palantir's total RPO growth and subsequent quarter commercial revenue growth observed since the beginning of 2025. Land and expand is working. Management has recently disclosed that AIP remains a consistent driver of existing customer deal expansions, as well as new customer conversions, especially in the US. This is corroborated by 45% year-over-year growth in Palantir's customer count to 911 in Q3, as well as 38% year-over-year growth in LTM revenue generated from its top 20 customers to $83 million per customer. This collectively corroborates Palantir's consistent execution on its land and expand business model, with revenue driven by both additional customer deployments and newly acquired conversions. As AIP adoption rises, especially in expansion-led deployments, related growth will become increasingly reflected in the form of contract extensions and incremental workloads. These are dynamics that can't be adequately captured by the current RPO alone, as less of the expanding contract value is expected to be recognized within a 12-month period. Instead, a greater mix of contracted backlog now resides in total RPO. As a result, forward revenue recognition will become increasingly tied to the absolute increase in customer contract values, instead of how fast those relationships can be converted into sales. This dynamic shift effectively reduces the dependence of near-term commercial revenue growth on current RPO alone and diversifies its exposure to the scale of total contracted backlog. Taken together, total RPO is likely emerging as the more informative indicator of Palantir's forward sales conversion trajectory, especially for its commercial segment. As total RPO continues to demonstrate year-over-year acceleration, it reinforces Palantir's longer-term revenue visibility and strengthens durability to the multi-year growth expectations embedded within its current valuation premium. Specifically, Palantir reported 66% year-over-year RPO growth. Considering the historical differential of about 2.4 percentage points observed between RPO growth and subsequent quarter commercial revenue sales growth, the pattern could imply Q4 commercial revenue sales growth of at least 63.6% to 68.4%. Coupled with forward government revenue projections in line with consensus estimates, Palantir could achieve full-year 2025 revenue of at least $4.4 billion. This would be consistent with management's raised full-year 2025 revenue guidance of $4.396 billion to $4.4 billion, provided during the Q3 earnings update. Taken together, Palantir's current valuation premium, which prices in a 30% plus multi-year growth trajectory, as discussed in my previous coverage, likely remains intact and substantiated by tangible forward revenue visibility. 2. Adjacent growth reinforcements. The durability of Palantir's RPO acceleration, a critical precursor to sustaining its elevated revenue growth and earnings accretion trajectory, is further reinforced by the strength observed across adjacent key performance indicators. This includes strong acceleration observed in Palantir's RDV, which grew 91% year-over-year to $8.6 billion in Q3. As discussed in the earlier section, Palantir's RDV differs from RPO in that it also includes customer contracts with a duration of less than 12 months and contracts that are subject to termination clauses and presumes exercise of all contract options. As a result, RDV has historically been a key directional indicator of forward demand, rather than a tangible proxy for contracted revenue visibility. However, it's likely that Palantir's RDV will become more closely linked with RPO growth going forward, considering Palantir's evolving end-market demand dynamics. Specifically on the commercial front, accelerating AIP adoption continues to underpin larger and longer duration contract wins. This effectively reduces the prevalence of contracts with original terms of 12 months or less, which aren't included in RPO. Meanwhile, Palantir's resonance with the Trump administration's increasing prioritization of defense tech modernization efforts also reinforces its reach into larger, longer-dated government contracts. These end-market demand dynamics collectively underscore increased RDV inclusion in RPO going forward. Meanwhile, Palantir's total contract value (TCV) bookings are also expanding rapidly, up 151% YY to $2.8 billion in Q3. Taken together, the strength observed in elevated RDV and TCV bookings growth is expected to reinforce RPO acceleration, and by extension, Palantir's forward sales conversion and revenue expansion prospects. The growth dynamics also reinforce structural long-term demand for Palantir's portfolio, rather than speculative sentiment driven by secular AI optimism, and reflect the company's increasingly mission-critical role in serving next-generation AI data analytics needs. This, accordingly, bolsters durability to the 30% plus multi-year growth trajectory that currently underpins Palantir's valuation premium. 3. Competitive edge led by AIP's expanding breadth. Palantir's recent expansion of AIP native features is also expected to accommodate its land and expand business model by deepening monetization across the product's installed base. This could provide incremental reinforcement to the pace of acceleration currently observed across its key growth indicators and further preserve long-term revenue visibility. These features include AI FDE, an AIP native agent that can translate natural language requests into Foundry operations. Specifically, AI FDE is capable of performing data transformations and interacting with data within Foundry. It can also help customers build and maintain ontologies, develop applications, and/or drive critical decision-making insights from them. During the Q3 earnings update, management highlighted AI FDE's differentiated value proposition in enabling substantial productivity gains for existing AIP customers. At one customer, 2 human FDEs spawned an army of AI FDEs to migrate a customer off their legacy data warehouse in 5 days, something that would have taken an army of SIs up to 2 years. This is not a prototype. This is production. Across our customers, the results are shocking. Source: Palantir Q3 2025 earnings call transcript. According to Palantir's product documentation, AI FDE is currently in the beta phase of development, underscoring additive growth prospects when the add-on AIP feature enters general availability. Similarly, AI HiveMind is another agentic solution aimed at extending AIP's value proposition across both government and commercial settings. AI HiveMind is an AIP native feature capable of leading dynamically generated agents to engage in solving complex problems and executing orders based on customers' data ontologies. According to management, AI HiveMind was originally developed to solve extremely complex problems in the classified space and is natively integrated in Palantir's Gaia application, within the government-centric Gotham operating system. Now the feature is expanded for use in commercial settings, identifying and solving enterprise problems like supply chain bottlenecks by collaborating with AI FDE. Meanwhile, Palantir is also rolling out Edge Ontology, a lightweight implementation of its proprietary ontology optimized for running on mobile devices. As discussed in one of my previous notes on Palantir, the company's proprietary development of the ontology has been its most prized possession. It's essentially the core engine that enables rapid scaling of Foundry, Gotham, and AIP's time to value for customers. And the edge-optimized version of this solution is expected to reinforce Palantir's reach into long-term monetization opportunities as compute dynamics evolve. Specifically, the advent of AI has fueled the diversification of enterprise compute dynamics from centralized cloud workloads to distributed deployments on edge devices spanning autonomous systems, drones, robotics, and industrial equipment. This accordingly makes Edge Ontology a critical reinforcement to the long-term durability of Palantir's elevated RDV, TCV, and RPO growth, further underpinning its forward revenue visibility and ensuing margin expansion at scale. Fundamental and price considerations. Taken together, I'm maintaining my base case price target for Palantir at $180 per share. The price target is computed under a discounted cash flow analysis on base case fundamental projections spanning 2026 to 2035. The forecast reflects revenue expansion from 2026 at a 5- and 9-year compound annual growth rate of 34% and 29%, respectively, alongside earnings accretion at a 5- and 9-year compound annual growth rate of 43% and 35%, respectively. The fundamental assumptions considered are consistent with my foregoing analysis on the durability of Palantir's near-term revenue acceleration prospect, as well as its longer-term growth and earnings accretion trajectory. Meanwhile, key valuation assumptions applied include a perpetual growth rate of 3.5% applied to the terminal value, proxied by the estimated 2035 EBITDA in determining Palantir's terminal value. The perpetual growth rate assumption is consistent with the anticipated pace of economic expansion across Palantir's core operating markets and reflects the rate at which the company can sustain long-term FCF accretion as the business matures. Total cash flow projections, including the terminal value, are discounted at a WACC of 8.8%, which is in line with Palantir's capital structure and risk profile. What can go wrong? A key risk overhang facing Palantir is its increasing involvement in political controversy. From day one, CEO Alex Karp has stated in a letter embedded within Palantir's Form S-1 filing that the company has chosen sides and will only support Western liberal democracy and its strategic allies. While Palantir's government segment is largely de-risked from its strategic mission, the commercial segment remains prone. Specifically, existing and prospective enterprise customers, including those based in the US and allied countries, may not always resonate and align with Palantir's political views. This includes recent attention on Palantir's ongoing work with the ICE and the Defense Department amid escalations in both domestic affairs and geopolitical tensions. Karp responded that these relationships have provoked protests inside and outside the company, highlighting potential risks to operations. The implications are also clearly acknowledged in the business and industry risks outlined in Palantir's latest 10K, emphasis in original. Our reputation and business may be harmed by news or social media coverage of Palantir or our leadership, including but not limited to coverage that presents or relies on inaccurate, misleading, incomplete, or otherwise damaging information. Conversely, being perceived as yielding to activism targeted at certain customers could damage our relationships with certain customers, including governments and government agencies with which we do business, whose views may or may not be aligned with those of political and social activists. We may not enter into relationships with potential customers if we consider their activities to be inconsistent with our organizational mission or values. Although we endeavor to do business with customers and governments that are aligned with our mission and values, we cannot predict how the activities and values of our government and private sector customers will evolve, and they may evolve in a manner inconsistent with our mission. Source: Palantir 2024 10K. Another potential risk that could disrupt Palantir's growth trajectory is the rising risk of talent drain. Specifically, the Trump administration's pro-defense tech agenda has encouraged an upsurge of startups similar to Palantir. Aside from competition, which I believe Palantir's technology and business model continue to hold a deep moat against, the emerging startups could risk disrupting the company's talent composition, which is critical to maintaining its current scale. This is reflected in management's acknowledgement that investing in the most elite technical talent remains a strategic priority for Palantir. It's also corroborated by risks elaborated in Palantir's latest 10K filing. If we are unable to hire, retain, train, and motivate qualified personnel in senior management, including Alexander Karp, one of our founders and our chief executive officer, and deploy our personnel and resources to meet customer demand around the world, our business could suffer. Source: Palantir 2024 10K. Palantir's commitment to preventing talent drain is also reflected in the company's recent lawsuit against certain ex-employees. The company claimed that the ex-employees have allegedly violated non-compete clauses and improperly poached Palantir employees and stole confidential documents, which the defendants have called a scare tactic. The combination would not only risk driving up near-term legal expenses for Palantir, but also expose the company to higher personnel costs to retain talent. This could suggest risks of resurgent stock-based compensation expense, which has previously been a drag on its margins. Any added pressure to Palantir's near-term profitability could potentially weaken the durability of the stock's current premium. Final thoughts. Taken together, Palantir looks well-positioned for a potential upside surprise on both the Q4 financial results and 2026 outlook heading into its upcoming earnings update. This strength is not dependent on surface secular AI tailwinds, but rather rooted in tangible execution consistency, with durability reflected in sustained acceleration across its key growth indicators. The company's increasing mix of expansion-led growth is also expected to reinforce sustained margin expansion at scale and drive earnings accretion, critical to the cash flows underpinning its valuation. This is further reinforced by Palantir's pivot to expanding the breadth of AIP-native features, which will bolster long-term monetization and compound growth stemming from installed base expansion. Looking ahead, the 30% plus multi-year growth trajectory embedded in Palantir's premium remains intact, with its upcoming Q4 earnings update likely to set the tone for 2026 expectations. An upside surprise could further lift its growth and earnings profile, potentially underscoring a re-rate for PLTR stock from current levels. This article was written by Summit Research.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis, wild and insightful, just like me.